issuers around the country and around the world. Treasury Secretary Timothy Geithner outlined plans Thursday to rewrite the nation's financial rules as part of what the Wall Street Journal described as the most comprehensive changes to financial market regulation since the New Deal. Geithner's plan includes the creation of a single regulator to monitor any firm whose failure could threaten the financial system.
Our system failed in basic fundamental ways. Compensation practices rewarded short-term profits over long-term return. Pervasive failures in consumer protection left many Americans with obligations they did not understand and could not sustain. The huge apparent returns to financial activity attracted fraud on a dramatic scale. Market discipline failed to constrain dangerous levels of risk-taking throughout the system. New financial products were created to meet demand from investors, but the complexity outmatched the risk management capabilities of even the most sophisticated institutions in the world. To address this will require comprehensive reform, not modest repairs at the margin, but new rules of the game. And the new rules must be simpler and more effectively enforced. They must produce a more stable system, one that protects consumers and investors, rewards innovation, and is able to adapt and evolve with changes in the structure of our financial system.
Treasury Secretary Geithner also called for extending federal regulation for the first time to all trading in financial derivatives and credit default swaps that are blamed for much of the economic crisis. Under his plan, the government would also be empowered to take over major non-bank financial firms such as insurers and hedge funds if deemed necessary.
Geithner's call for new regulations on Wall Street comes just days after he introduced a controversial proposal for the government to form public-private partnerships to take troubled assets off the books of banks. To talk about these stories, the economist and writer James Galbraith joins us from Austin, Texas. He's professor of public affairs and government at the University of Texas. His most recent book is The Predator State: How Conservatives Abandon the Free Market and Why Liberals Should Too. His latest article, No Return to Normal, appears in the current issue of the Washington Monthly. You are concerned about Tim Geithner's plans over the last few days. Lay out your concerns, Professor Galbraith.
Public-private partners.
Well, if you can possibly bear with yourself hearing, hearing yourself reverberating in your ear, we're not hearing that echo.
For transferring the risk that the underlying assets will go bad from the banks themselves by getting them off their books, largely to the Federal Deposit Insurance Corporation, which would offer a non-recourse loan for about 85% of the value of the assets that are being purchased. And the difficulty I have with that is that I think that plan is based upon an excessively optimistic assessment of the prospects for those assets. And what Secretary Geithner said yesterday, that these assets were issued to consumers that in many cases did not understand what they were getting into, and that they were magnets for fraud. Both of those remarks are absolutely true. But once one, I think, takes that into account effectively, you realize that the prospects for capital losses on those assets are really very, very high. The recovery rates are likely to be quite poor. And that we've already seen that with the banks that the FDIC has taken over, specifically with NDMAC in California. And so that suggests to me that this is this plan would have the effect of transferring the losses to the taxpayers without exacting any serious consequences for the banks that essentially created the fiasco. And since the financial system has to shrink one way or another, if you protect the largest banks, as I think the Treasury plan does, then the consequences will fall on other financial institutions which are relatively well managed and which did not take part in the the same degree in the subprime debacle, and those would tend to be smaller banks. And I think it's really it's likely to be promote an unmanageable banking structure if we go that route. And secondly, it's not going to solve the problem which everybody would like to see solved, which is the complete breakdown of the credit system. It's not going to bring the economy back to life by the vehicle of new bank spending.
Well, in your article, No Return to Normal, you make the point that it appears that the Obama administration is still dealing with this primarily as a crisis of flow in credit and not a crisis of the actual collapse of the financial system. And could you explain precisely in what way they are missing that fundamental point?
Well, we hear this expression that credit flows are blocked and that there is a need to get credit flowing again. And it really is, it's a metaphor. And I think it's a revealing metaphor if it in fact reflects the way in which high officials of the government are thinking about the problem. The idea of a flow, of course, is something that comes from on high and goes down below. A blockage is a kind of plumbing problem. The difficulty is credit isn't like that. Credit is a bilateral contract. It's a relationship between a lender and a borrower. And the problem is not that the lenders don't have money to lend. The problem is in very large part that there are no prospects or very few prospects for profit in the economy, and therefore borrowers, business borrowers, aren't coming in to ask for loans for economic expansion. And secondly, on the residential and household side, households are strapped. They're desperate to hang on to the cash that they have. They're trying to pay down their debts, not to get into new debts. For that reason, they've stopped buying cars and stopped buying houses for the time being. And then even if they did want to come in many cases, they don't have the collateral that they had last year or the year before because the value of their houses has fallen. So those are the problems of the underlying economy, the consequences, to be sure, of the collapse of the housing, of the subprime housing bubble. But they're not problems that can be solved by simply adding new reserves, new capital to the banks. And in fact, we've seen that the banks are flush with cash. They're largely sitting on it. And to the extent that they're not sitting on it, they may be using it for things like acquisitions of other banks, for instance. So the effect of the program is actually to expand the market share and the market power of the largest institutions. And again, to me, that is deeply problematic because we've got banking institutions that are so large at this point, they're so complicated, so opaque, so deeply involved in offshore tax havens, shell corporations, and complicated derivatives that they can't be managed, let alone regulated. The top executive officers didn't know to a very large extent, or at least by their own testimony, they didn't know the risk exposure of their own institutions. And they made catastrophic mistakes on the scale of tens and scores of billions of dollars because they didn't have effective internal controls. And if you don't have the internal controls, there's just no way that an outside regulator can get a grip on the systemic risk that the institution may be causing. So my view is if you want to have a system that has appropriate checks and balances, the institutions in that system have to be of a scale such that the regulators, which Secretary Geithner properly said yesterday must be strengthened, but they also have to have the basic capacity to deal with the institutions that they're regulating.
In his column in today's New York Times, Paul Krugman raises similar points, but I guess from a different perspective. He raises the question that the administration is attempting basically to put Humpty Dumpty back together again, to restore this process of securitization that became so prevalent among banks, securitizing mortgages and auto loans and credit card debt. And he says that they're not confronting the fact that that method that has reigned now in banking for decades now has collapsed and is a failure, and something else must be done. Do you agree with that?
Well, I would take a modest exception to it by way of going a bit further. It is not the case that the securitization of subprime mortgages is a long-term phenomenon. It is something which has been a practice, prevalent practice, for about 8 years at the maximum. Before that, the markets would not have contemplated the massive securitization of loans which are subprime. What does the subprime mean? Subprime means loans that do not meet the standards for a normal mortgage loan that could be taken up by the secondary markets, by Fannie Mae and Freddie Mac. And so those loans are characteristically loans that don't have documentation, that don't have proper credit histories on the borrowers, and where the appraisals seem a little funny. And in the case of the subprime